Fairfax is known as Canada's Berkshire Hathaway, and its founder and current CEO, Prem Watsa, is called Canada's Warren Buffett because he is a value investor proven over several decades. And living up to that reputation, since 1985, Fairfax's share price has compounded at 19.5% a year, decisively outpacing the S&P 500, which returned 11.5% over the same period. As you can see here in green, while the S&P rose 77-fold, Fairfax, the red line, delivered over 1,000-fold return. That is even higher than Berkshire Hathaway's 15.4% annual return over the same stretch. And among every company listed in the United States since 1985, Fairfax falls in the top 1%. Beyond this decades-long proven track record, Fairfax offers additional investment merits. For example, Fairfax's market cap today is only about 1/30th of Berkshire's, which makes it far better positioned to sustain high returns than Berkshire, that has grown almost too large. And compared with Buffett, who has now stepped back from the front line, Prem Watsa is 20 years younger. So this legendary investor looks set to lead the company for at least another decade, and that's a major advantage. In today's deep dive, we'll find out whether Fairfax really offers the kind of compounding opportunity Berkshire once did, and whether any hidden risks or opportunities are lurking underneath. Let's start with the business model. The biggest reason Fairfax gets compared to Berkshire is that the two companies create capital and put that capital to work in structurally similar ways. Here's how it goes. First, an insurance company collects premiums from its customers, and until an accident actually happens and the claim is paid out, the insurer can invest that money and earn a return. That pool of capital is called float, and this is where a metric called combined ratio comes in. It rolls the insurance operations profit and loss into a single number, and in short, if that number is below 100%, the insurance business itself is turning a profit. You're holding other people's money for free. No, better than free. You're being paid to invest it. Conversely, if the combined ratio is above 100%, the underwriting is losing money, and that loss has to be covered by investment returns, which is a negative situation. Fairfax invests this float along with the company's own equity into bonds, stocks, associates, and acquisitions, and it does so using a conservative value investing approach. Fairfax's various subsidiaries are also decentralized, each left to run itself. Every business is managed directly by executives with deep expertise in that specific field, but the exact opposite applies one level up. Big picture, capital allocation, financing, and investment decisions are all centralized, handled personally by Prem Watsa at Fairfax headquarters. Many of you have probably noticed already the four elements that just came up in this description of Fairfax's business model. 1. An insurance float that generates profit. 2. Conservative value investing spanning stocks, bonds, and M&A. 3. Extreme decentralization of the operating subsidiaries. And in direct contrast, 4. Extreme centralization of capital allocation are exactly the core elements that have held up Warren Buffett's Berkshire. And the numbers make that resemblance even clearer. Fairfax's float in 2025 stood at $40.8 billion, and its investment portfolio reached $74.9 billion. And nearly half of that capital is invested ultra-conservatively in cash and government bonds. The yield on Fairfax's bond portfolio is only about 5%, but the duration is short, just over 2 years, meaning it's built very conservatively. Short maturities are defensive, and yet, if a sharp sell-off comes, that structure lets Fairfax move fast and scoop up undervalued names. It looks much like Buffett, sitting on hundreds of billions in cash while holding a conservative stance. And despite that conservative portfolio, without stretching in the slightest, Fairfax's earnings work out to roughly $150 per share. Against the current price, that's a PE of only about 11. But what's even more interesting here is the cost of the insurance float. Over the past 10 years, Fairfax's cumulative underwriting profit came to $8 billion. In other words, Fairfax didn't pay a cost for the privilege of holding that float and investing it. It was actually paid roughly 3% a year to do so. That runs against everything conventional insurance economics would tell you, and it's a very good situation for shareholders. Insurers run this well can be counted on one hand worldwide, and Berkshire and Fairfax are both on that list. Up to this point, everything looks perfect, but across Fairfax's first 40 years, not everything ran perfectly. For a long stretch, for instance, Fairfax traded below book value at a discount, and there were legitimate reasons for that. The trouble began in 2003. A brokerage called Morgan Keegan published a report challenging Fairfax's accounting, and the stock dropped about 13% in a single day. Parts of that report were later corrected as double counting errors, but the episode exposed just how complex Fairfax's disclosures were, and that the market did not yet fully trust this insurer, which at the time wasn't even 20 years old. In 2006, an accounting restatement issue also surfaced, which again helped cement the perception that Fairfax was excessively complicated. there were issues on the investment side too. Unlike today, with its focus squarely on conservative traditional value investing, about 20 years ago, Fairfax was also making more aggressive macro bets. For example, during the 2008 financial crisis, a bet placed through credit default swaps earned roughly $4 billion. But the problem was that these hedging positions stayed in place long after the 2008 crisis had passed. From 2010 through 2016, Fairfax carried large hedges and short positions against a market crash, and as a result, in 2016 alone, the hedges lost more than $2.6 billion. And what hurt even more was that, over that same stretch, Fairfax failed to ride the bull market that was underway. For the record, these hedges weren't unwound until the fourth quarter of 2016. Doubts about the investment assets carried on until quite recently, too. In 2024, the short-selling firm Muddy Waters claimed that Fairfax's book value was overstated by 18% or $4.5 billion. Fairfax denied every one of those claims, and the 2025 audit opinion came through without modification, so the matter appears to have settled. Even so, it's hard to say that every question surrounding the complexity and opacity of Fairfax's accounting has completely disappeared. Given an insurer's books and illiquid, privately held assets acquired through M&A, it can take several years before we know for certain which side was right. The good news is that Prem Watsa acknowledged the problems that ran through 2016 and succeeded in resolving them himself. And that change shows up quite clearly in the numbers from 2017 onward. Fairfax used to be a company whose results swung sharply with each year's investment outcome. But with the 2017 acquisition of Allied World, which broadened its global specialty insurance platform, the center of gravity of the company's overall earnings shifted from lumpy directional macro bets toward recurring operating income. The combined ratio we covered earlier has now produced 8 consecutive profitable years from 2018 through 2025, averaging 95%. Because simply holding the float earns around a 5% return, Fairfax can actually afford to invest more conservatively. On top of that, when rates rose in 2022, Fairfax captured the full benefit. For example, the interest and dividend income the company earned was around $600 million in 2021, but by 2025, it had reached $2.6 billion, a nearly fourfold increase. As we saw earlier, even with half the float invested only in the safest short-term government bonds, it now generates more than enough income. And even as the company's fundamentals grew stronger, the market still held on to its concerns about Fairfax, so Prem Watsa used the undervalued share price to buy back stock aggressively. As a result, Fairfax's share count has fallen roughly 25% since 2017, and shareholders have enjoyed rising intrinsic value per share. So far, we've looked at Fairfax's fundamentals and its history. Now let's lay out the core arguments, the bull case versus the bear case, for Fairfax's future. First, the heart of the bull case isn't that Fairfax is a better company than Berkshire. It's this: the two share a similar business model, but because Fairfax is so much smaller, it's better positioned to grow, whether by deploying new investments or by continuing to build out the insurance business. Berkshire's market cap is now north of $1 trillion, while Fairfax sits at about $34 billion, 1/30th the size. Put simply, an investment far too small to matter for Berkshire can be an opportunity that lifts Fairfax's results for years. Mid and small-sized M&A and thousands of listed stocks that hold no appeal for a Berkshire that has grown so enormous are all still viable targets for Fairfax. The bull's second point is the hidden value not yet reflected on the balance sheet. The market value of the associates and investments Fairfax holds is set to run about $3.9 billion above the value carried on its books. That works out to $190 per share pre-tax, more than 10% of the current share price. This hidden value isn't fully captured in book value until the assets are actually sold or the accounting treatment changes. But as time passes, that hidden value grows, and whenever a related transaction draws attention, it can become a catalyst for the share price. The third point is India. Fairfax, the holding company, holds about 43% of the economics and roughly 95% of the voting rights in its subsidiary, Fairfax India. Its core asset is Bangalore International Airport, meaning Fairfax is invested in core infrastructure of an Indian economy that keeps growing fast. Before long, if the related subsidiary Anchorage lists on the Indian stock market, the share of assets marked at market prices could rise from 31% to 85%. And the Fairfax parent company we're analyzing today also collects investment management fees from this Indian subsidiary. So by investing in the Fairfax holding company, you gain exposure to India's economy and stock market as they keep growing over the medium and long term. It's notoriously difficult for a foreign investor to run active alpha-seeking strategies in India. So there's an added benefit here. A proven value investor, Prem Watsa, is executing those Indian investments on our behalf. Now let's lay out the bear case. First, doubts about the quality of the insurance operation. Fairfax's underwriting performance ranks near the top of the industry, but next to Berkshire, it looks a step below. In 2025, for instance, Fairfax's combined ratio was a strong 93%, while Berkshire came in at 87%, a notch better. Berkshire also leads on the long-term average of that number. And on top of that, Fairfax leans more heavily on reinsurance, the Lloyd's market, emerging markets, and specialty insurance, which carries the risk of greater earnings volatility and greater catastrophe exposure. The second drawback people point to is high leverage. Fairfax's debt-to-capital ratio is 28%, higher than Berkshire's. In absolute terms, you can't call 28% excessive, but the issue is that this leverage rose at precisely the moment the valuation was climbing and the buybacks were continuing. If catastrophe losses, reserve issues, and investment losses all struck at once, Fairfax's cushion to absorb them would be thinner than Berkshire's. The complexity of the assets is a double-edged sword too. Berkshire holds a large share of highly liquid mega caps like Apple, Google, MasterCard, and Coca-Cola, along with wholly owned operating businesses. Fairfax, by contrast, leans more on associates and assets valued in private markets. That hidden value we saw earlier can be an upside driver, but the very fact that these values are marked subjectively is, at the same time, Fairfax's discount factor. This time, I've pulled together 4 checkpoints to keep watching if you're already a Fairfax shareholder or if you're considering an investment. First, checking that the insurance business stays profitable. In a market environment where premiums weaken and soften, you need to check every quarter whether the combined ratio holds below 100 and whether reserves stay healthy. Second, capital allocation. You need to confirm that acquisitions in listed stocks or bonds and buybacks are actually being used in ways that raise per share value. Third, the realization of hidden value. Whether the off-balance sheet hidden value and the India optionality we saw earlier convert into real cash, market prices, or higher book value through something like a Poseidon sale or an Anchorage listing is something you track through the related IPOs and stake sales. When these positive events materialize, concerns about Fairfax's complexity and asset values ease and the share price can rise. Conversely, if these events are delayed or executed at lower prices than expected, they act as a potential risk factor. The last one is valuation. Fairfax currently trades at about 1.33 times book value, which is higher than its 5-year average of 1.14. The extreme undervaluation of the past is already gone, so future returns will lean far more on real per share compounding than on any re-rating of the multiple. And because the 3 factors just mentioned will move intrinsic value per share, you can track whether that makes the valuation more attractive or less so, and use it to judge your own target by price and the timing of any additional purchases. If I had to sum up today's video in exactly 3 points. First, with its conservative generation of insurance float, its conservative value investing, and its founder-led centralized capital allocation, Fairfax is a company that closely resembles Warren Buffett's Berkshire. If you don't currently have any exposure to insurance, it's high enough in quality to earn a place in a long-term compounding portfolio. Second, you do need to recognize that compared with Berkshire, Fairfax carries higher leverage, more accounting complexity, and greater exposure to short seller attacks. In other words, slightly more risk than Berkshire. And finally, improvements in the insurance operation and the investment side since 2017 have upgraded the company another notch. And thanks to that, the discount it used to carry has almost entirely disappeared over the past few years. In other words, the window of extreme undervaluation has already passed. Even so, Prem Watsa keeps buying back stock aggressively, signaling strong conviction in Fairfax's future. Few would dispute that Fairfax is a good company, and for the record, I've been invested in Fairfax myself for years. But with the trading multiple higher than it was, whether there's still merit in a new or additional purchase is something each of you has to judge by weighing the 4 checkpoints we just laid out. If you'd like to see the fair value I calculate and use for my own investing, along with my expected return figures, sign up for my research platform through the link below this video. And if you'd like to watch my earlier deep dives on Berkshire Hathaway for free, this one is a good place to start.